Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and basically we are covering the banking awareness part of it, right? And in the previous lecture, we had finished the Exim Bank, right? Export and Import Bank. And also we have finished the topics like the National Housing Bank, Insurance Regulatory and Development Authority of India, okay? Pension Fund Regulatory and Development Authority, okay. Thereafter, we had talked about the Small Industries Development Bank of India. We had talked about the IDBI, okay, Industrial Development Bank of India. We have talked about SEBI, Securities Exchange Board of India, all right, and some other facts and figures also under the name of banking awareness. All right. So far, I hope that you have revised all the facts and figures which we have discussed in the previous lecture because these are for your own benefit. All right. So if we go forward, so today in this lecture, basically we are going to start with the IBBI, okay, which stands for Insolvency and Bankruptcy Board of India, okay, or in short known as the IBBI. This is another important topic which we are going to discuss in this particular series of the banking awareness. All right. And in the left side, you can see that these are topics which we are going to see here. Like we will start our discussion with the introduction part. Then we will see the background, then the establishment, then the objectives, the regulation, the insolvency professionals, the insolvency professional agencies, the information utilities, the advisory role, collaboration, CIRP, all right, educational awareness, and the summary part. Got it? So these are the topics we are going to see in this particular heading of IBBI. Okay, so please keep yourself attentive while we cover IBBI because IBBI is very, very important, not only from the examination point of view, but also from the economics point of view, financial point of view. And in future, if you go in the industries, okay, through the various government exams you are preparing for, so you will have to deal with the IBBI situations at some point of your life or your career point, you can say. So let's begin with the introduction part first. The Insolvency and the Bankruptcy Board of India is a key regulatory body in India that was established to oversee and regulate the insolvency and the bankruptcy process in the country. Okay. So it plays a crucial role in ensuring the smooth functioning of the Insolvency and the Bankruptcy Code, IBC, which was enacted in 2016 to consolidate and amend the laws relating to reorganization and the insolvency resolution of corporate persons, partnership firms, and individuals in India. So basically, what is the purpose of establishing IBBI? What do we mean by the insolvency and the bankruptcy? How it is beneficial for India and why it is important for ease of doing business. Ease of doing business. Okay. So how all the things related to each other? Let's start discussion over it. Okay. So basically, if we talk about the company and any corporation like the XYZ, we have taken example. Okay. So if I'm asking you, just find out whether the XYZ is having healthy financial condition or not. So how you will find it out? Like whether they having the healthy financial condition or not. How do you can say? So basically, there are two parameters, assets and the liabilities. Okay. about assets and liabilities, I have told you so many times, so I'm not going to explain them again. But what I will say, that assets are basically the powers of the organization and liabilities are basically the responsibilities which are to be discharged of by the organization towards the outside parties. So we have the assets and liabilities. Okay. So if we come back to the question, that the healthy financial condition. So healthy condition, okay, and then not healthy condition. So if we go by this, then the healthy conditions will be when the assets will be more than the liabilities. Okay, it means the XYZ having more power than its responsibilities. This is the healthy condition. Not healthy condition is when the assets were less than the liabilities. Okay, in such a situation, the XYZ having less safeguards in comparison with the responsibilities they are required to discharge of. So these are the two conditions, healthy and the not healthy. Okay, and here comes the words, the insolvency and the bankruptcy. Okay, two words here. They both are related to each other but different. Remember my words, related to each other but different. Okay, I'm not going to tell you the exact definition because you can just do a Google search, you will get it. But what I'm trying to do, I'm trying to explain it in a simpler manner so that you could retain this definition in your mind for a long time. Okay, so basically, if we talk about the not healthy condition, it means that suppose this is an organization XYZ. Okay, they having the assets, they having the liabilities. Okay, even when the assets are equal to liabilities, they are somewhat in a stable condition. Okay, because they having the responsibilities as equal to the powers they possess. Okay, but when the situation go downgraded and this become liabilities crosses over the asset, it means that suppose the XYZ having the assets of rupees 100 crores, but the liabilities were rupees 200 crores. So now you can see the liabilities are higher than the assets. It means that even after selling all the assets, 200 crores, sorry, 100 crores. 100 minus 200 will be 100 crores. 100 crores will be remain as liability on the XYZ. Okay, this brings the case of insolvency. Okay, so remember, insolvency starts when the assets becomes lower than the liabilities. Okay, it means when the liabilities are more than the asset, it is a case of insolvency. It means you have less, but you have to pay more. Okay, you having only 100 crores with yourself, but you are required to pay 200 crores. This is the case of insolvency. Okay, so remember when, or you can say, just say, this is that condition. Okay, this is the condition of insolvency. All right, so it means that the XYZ will declare itself as an insolvent entity. It means that they do not having a sufficient assets to discharge of their liabilities. Okay, they will give up. That's the simple meaning of the insolvency. Okay, because they having only 100 crores, they are required to pay 200 crores. Even after selling on the assets, they will receive only 100 crores and the remaining 100 crores will be remain as the liabilities. Okay, then all these assets will be sell off to the market. Okay, and thereafter the amount will recover. Okay, and this amount will be granted off to the creditors or the investors who had invested their money in the XYZ, okay, maybe in the equitable portion or as per the share. All right. However, there will be some loss to the investors. Why? Because the total amount invested was 200 crores, but the recover amount was only 100 crores. Okay. But at least some amount will be given to them. Okay. And when all the assets will sell out to the market, okay, and you can say no asset will be left off with the XYZ, then they become the bankrupt. Okay. So this is the simple, you can say, procedure and the phenomena. First, start with the insolvency. When the liabilities are crossing over the asset, it means that liabilities are higher than the assets they have. They become the insolvent. They declare that we do not having a sufficient asset so that we could discharge our liabilities. First case. Second case is the bankrupt. Okay. All of their assets will be sold off to the market. The recover amount will be distributed to the investors, and then no asset will be left with the XYZ, and then they become the bankrupt. Okay. So now the condition is why it is important for the economic growth, and why in the starting I have told you that it is very, very important phenomena for ease of doing business. Okay. Ease of doing business. Why? A healthy economy possesses two things. What are these things? Easy entry and easy exit. Two things. Easy entry means when, suppose, if this is an XYZ, okay, when they want to commence their business in the Indian market or the Indian economy, they could easily start it. Means their licensing process, their approvals, their regulations, all the things should be done in a smooth manner. This is called the easy entry. It means that easily they could start their business. All right. Now the easy exit, what do you mean by it? Okay, suppose if the condition arises that the XYZ's assets are lower than the liabilities, it means they become insolvent. They do not having a sufficient amount to discharge of their liabilities. Okay, so in such a case, they want easy exit from the market. It means they want to shut down their business. Shut down the business. Got it? So that's why the easy entry and exits are necessary. It means that when the company want to commence the business, they could easily start it. And when they are facing the loss, it doesn't mean that they should facing the loss. Okay, mark my words. Basically, if there is no facility of becoming insolvent, then sell off their assets and liabilities. So what will happen? The company will facing a loss again and again. Why? Because they could not liquidate their assets so that they could discharge of their liabilities. If there is no provision of the insolvency and the bankruptcy, then the company is not allowed to exit the market. All right. They have to face the loss on the continuous basis. And this will downgrade their position much more. All right. But if they are provided with the facilities of insolvency and the bankruptcy, it means that when they find themselves unable to discharge of their liabilities, they could easily initiate the process of insolvency, liquidate their assets, discharge of their liabilities at some extent, become bankrupt, but at least are no longer required to face the losses and stick or maintain their position in the market. Got it? So that's why it is necessary. And when the easy entry and exit provided to the businesses, they find themselves much more comfortable in doing the business. And this is what we call ease of doing business. Okay, it means you could not only easily start your business, but you could also get out from the market when you feel that you should be. Okay. So remember, IBBI plays a crucial role in ensuring the smooth functioning of the insolvency bankruptcy code. It means that the code is the rules, regulations, steps you can also say, which are to be followed in order to become insolvent, bankrupt, and liquidation of assets and recovery of the investor's amount. All right. This was passed in the year of 2016. Now it is very, very important. 2016. The question will be asked to you, like, when was we introduced the IBC, Insolvency and the Bankruptcy Code in India? Please remember the year was 2016. To consolidate and amend the laws relating to the reorganization and insolvency resolution of corporate persons, partnership firms, and the individuals on India. You can say not only the corporates are being facilitated with the policy of insolvency and bankruptcy, but partnership firms also and the individuals in India are also allowed to become the insolvent and bankrupt. Okay. Thereafter, now, after taking the introduction and after taking the briefing over the insolvency and the bankruptcy process, now it's a time for the background, like how the things was done. The Insolvency and the Bankruptcy Code 2016 introduced in India to provide the comprehensive and time-bound framework for the resolution of insolvency and the bankruptcy cases across various sectors, including the individuals, the partnership firms, and the corporate entities. Like you can say, whenever the XYZ decided to stop their business, they are no longer required to face off the losses. Okay, they want to initiate the process of insolvency. Okay, thereafter, liquidation of assets. Okay, then recovery of amount and then paid it to the investors. Okay. First is insolvency. Second is liquidation of assets. Third is recovery of amount. Okay. Fourth is bankruptcy. Okay. So all of these process, how it's to be done, these all are mentioned under the Insolvency and the Bankruptcy Code. All right. Thereafter, time period. This process is the time bound. Why? Because it will protect the chaos situation in the market. Suppose you can say, if we talk about the XYZ. So when the XYZ declared that they do not having a sufficient assets with them so that they could discharge of their liabilities, what do you think? What will be the reaction of the creditors? Will they say, okay, you are my friend, don't worry? No. They will ask that when we will get our money back, right? So this is the process of the time foundation. It means that the creditors will be informed that within 90 days, 180 days, and whatsoever time period will be chosen during the process of the insolvency. Okay, within this time period, all of the assets will be liquidated, amount will be recovered and distributed to the investors, and the company will be declared as a bankrupt. Okay, so please remember comprehensive and the time-bound framework for the resolution of insolvency and bankruptcy cases across the various sectors. Okay, like the individuals who has taken the loans from the banks and started business, like the partnership firms and the corporate entities. Okay. All of them are being benefited with the bankruptcy and the insolvencies. All right. The IBC aimed to consolidate and amend the laws relating to the insolvency and the bankruptcy and establish a robust institutional framework to handle such cases efficiently. Okay. Basically, prior to the IBC, there were so many laws. Okay. There were so many laws which are related with the process of insolvency and the bankruptcy. Okay. And these cases and these laws, basically, they were not well defined, or you can say undefined and unclear. Okay. And because of this, there are so many confusion created in the market. Okay. Like, as per the sum law, the company could easily liquidate, could easily become insolvent or bankrupt. As per some law, no. As per some law, up to some extent. As per some law, nothing could be done. The entire amount is to be paid to the creditors from wherever it will be arranged. So there are so many things. All right. So to counter all of these things, what we did, we basically consolidate and amend the laws. Consolidate and amend the laws which are relating to the insolvency and the bankruptcy, and establish a robust institutional framework to handle such cases efficiently, because right now all of these cases are combined together. All of these laws basically are combined together. Okay. Now, if we move forward, thereafter we have to talk about the establishment part. Okay. The IBBI was established on the October 1, 2016 under section 188 of the Insolvency and the Bankruptcy Code 2016. Remember, this thing is very, very important. Okay. There are two things. First is the IBC 2016. Second is the IBBI. Okay. (2016). Okay. If we talk about the first one, it is the Insolvency and Bankruptcy Code 2016. All right. If we talk about the IBBI, it is Insolvency and Bankruptcy Board of India. Okay. They both are related to each other but different. IBC basically a main framework. This is the main framework. All right. Or you can say main legal mandate. Okay. Whereas IBBI is a body established by section 188 of the IBC code. Got it? So please keep this thing in your mind very, very clear. IBC, main framework and the legal mandate, Insolvency and the Bankruptcy Code 2016. IBBI, Insolvency and the Bankruptcy Board of India. Basically, it is a body established under section 188 of the IBC code. Okay. So remember this thing. The establishing date of the IBBI was the 1st October 2016. Okay. Section, please keep this thing in your mind. Thereafter, the IBBI was constituted as a statutory body, meaning it derives its powers and functions from a specific statute, in this case, the IBC. All right. So please remember, the IBBI is a statutory body. And as we know, there are three types of body. The charter body. Okay, let me write down again. Charter body. Okay. Constitutional body. All right. Legal body and the statutory body. Okay. Charter body, as we know, has been established by the royal orders of king and queen. Okay. The constitutional bodies are the bodies which having their power source in the Constitution of India. Legal bodies are the bodies which are established under some legal acts, whereas the statutory bodies are the bodies which having their own rules and regulations and has been established by passing their act. Okay. That's only we have a one body also, we call this autonomous body. Autonomous body is a body which has been established under some well-established organization, but has been granted the autonomous powers to carry out their operations and functions separately. Okay, so keep this thing in your mind. Thereafter, if we talk about the objectives part, okay, so basically in objectives, the primary objective of the Insolvency and the Bankruptcy Board of India is to regulate and oversee the functioning of key participation in the insolvency and the bankruptcy resolution process, including the insolvency professional agencies, and the information utilities. Okay, so as we know, the primary objective of the Insolvency and the Bankruptcy Board of India, IBBI, is to regulate and oversee the functioning of key participants in the insolvency and the bankruptcy resolution process. Okay, but this process is not one organization centric. Or you can say one point or stakeholder centric. Okay, it's having several stakeholders. All right, like the insolvency professionals, like the insolvency professional agencies, and the information utilities. Okay, so about them we will discuss in the next lecture. Right now we have discussed about the introduction, the background and the establishment, and we have taken the overview of the objectives part. All right, so this lecture we will finish here. Make sure that you have revised all the facts and figures in a proper manner before you come for another lecture. All right, with this note, let's end this lecture, and what we say thank you.